Hi, Philip here from Nathan Trust, and thanks a million for making the time to come on to another one of our webinars. Today we're going to talk about financial planning, and with us we have Iwan Thomas from Abbey Wealth. So Abbey Wealth were established in 2007 and are leaders in the financial services industry, and have a particular focus on expats and how to help with their wealth management. From Abbey, we've got Iwan Thomas, who's a senior wealth manager and Welsh born, but living in Ireland a good number of years. As you'll soon hear, he's really picked up a very strong Irish accent. Hello, Iwan.
Hi, Philip. How are you?
I'm good. So the format of, like all our webinars, this is going to be recorded. So we'll send around the link to the recording afterwards. And the format is much in a questions and answers format. So please get your questions in. Ask as many of them as you can, and we'll do our best to answer them. And if you have any questions that we don't get to, we can always answer them after the webinar ends. So we'll run it for about 20-25 minutes. So if you have a question, don't be shy, ask away. In the run up to this, we got a number of questions in from people who had signed up, which is always great. And we'll just jump straight into that, I guess. So the first one was just about when you, Iwan, when you engage with a wealth manager, what are kind of the top question, the top one or two questions you should ask before you get started with the wealth manager?
Well, there'll be a handful of things really you really want to be nailing down in the first instance when speaking to a wealth advisor, financial advisor. Firstly, probably most importantly, is their regulation. You know, where are they regulated? Are they regulated to give you advice where you're living, excuse me, in the jurisdiction you're living in? And essentially what that means is, are you protected if something goes wrong? If you're not happy with the advice that's been given, are you covered under that licensing and the regulation they have? To me, that is the number one priority that somebody should be looking at when they're getting financial advice. Beyond
what do you mean by covered? As in, so if you give financial advice and people lose money on it, the regulator can kick in and compensate you? Is that the way?
Well, it has to be that when given financial advice, and I'm sure some of the questions that come through, and I'll elaborate on it in a bit further, as a financial advisor, really, they should be giving you holistic financial planning. So looking at everything. And part of that is looking at things like affordability, suitability of products or investments, and you're looking at things like risk management. Okay, so the advice that the advisor is giving has to be in line with what that individual's clients' needs and objectives are, and tailoring a financial plan, if you like, for them. If in the event that there's a dispute, if you like, that the client is dissatisfied with the performance, or they feel that they were missold a particular product or whatever it might be, if they've been dealing with an unregulated advisor, then there's no cause for them to complain to the financial ombudsman, the central bank here in Ireland, or whatever it might be. It's highly unlikely anything significantly would go wrong, but for most firms, they're covered by public indemnity as well, and covered. So if there are any significant issues there, then you'd be covered from that perspective.
And is it fair to say, as a rule of thumb, that the financial advisor you're dealing with should be very upfront about where they're certified, where they're qualified, where they're regulated?
It's one of the first things I bring up with clients, if not the first thing. To let them know essentially who we are, what we do, and it should be it's reassurance for clients to know who they're dealing with are doing things properly. Okay, and arguably, off the back of that, then the next thing, and the one that you guys ask the most, and sometimes the first question you get of clients is, well, how much is this going to cost? Okay, and really you should be, if an advisor is not upfront for you from the outset about how much that advice is costing, okay, whatever the format, whether it's fees or commissions or whatever, if they're not upfront with you about those from the outset, then that's something that you should be running a mile, really. That is something that an advisor, when speaking to a client, should be quite explicitly and transparently explaining who's getting what and where, and what you're paying them for that service. Okay. I probably finally, off the back of that, I'd say, a lot of advisors are different. You'll have some advisors that are independent. They can, when you're speaking to them, they can look at the open market. Okay, they can pick the best available products to you from a An alternative perspective to that, you can have tied agents, and they're limited to what they can advise to you. So you want to have an understanding of what kind of advice you're dealing with as well. Are they looking at everything that's available to me in the market, or are they selectively picking particular products or investments? And I think of it, probably the most simplistic example of that would be if you go into your typical high street retail bank. Realistically, they're only going to be offering you their investments, their products. They're not then looking out. You go into Bank of Ireland, they're not then looking at seeing what investments are available in AIB, for example, to compare and contrast and see what's best for you. They're only going to offer you their products. When you're speaking to a financial advisor, for the most part, they should be telling you, whether they're independent, whether they're tied, and looking at the open market, ideally, to find the best product suited to you.
Okay. All right. Good to know. And okay, so just a couple of questions here. Just I see inflation is rising rapidly in the last 6 months. Should I be concerned with this, and what can I do to mitigate it?
Well, I guess it's firstly understanding the impact of inflation for anybody. It's been very prominent in the last 6 months, which is why stock markets in a sense have been quite volatile, the knock-on effect of that. But simplistically, if you're looking at inflation, if you were sitting on 100,000 euros in a current account, I'm sure most people, if they've got any savings, they're getting little to no return. They'd be lucky if they're getting 0.5% interest rate per annum on any of the savings. Okay, if you have 100,000 there sitting in the account, and inflation at the minute, which is considerably higher than it's been for a long time. In the EU, it's running at circa 5% per annum. In real terms, that 100,000, if you have it sitting on deposit doing nothing, in 12 months' time, it's going to only have a real-time value of 95,000 euros. Because what you can buy now, in comparison to what you can buy next year when things are more expensive, is different. So, in terms of what you should be looking at from an inflation perspective, it's in a simplistic format. Yes, it doesn't make sense to be sitting on large sums of cash doing nothing, because in real terms it's losing money. But again, when it comes to the importance of speaking to a financial advisor, a wealth advisor, it's not as simple as saying, well, I've got this cash, let me invest it. You want to be looking at a sound structured financial plan. What has that money been earmarked for? How long do you want to invest it for? When do you need it? Because if you have put money aside that you need in 6 months, 12 months, 18 months, let's say, for a house purchase or a holiday or whatever it may be, then it's not going to be within your interest to invest that in stocks and shares, for example, because you don't have time on your side in the event that markets, you invest today, World War III, if it hasn't kicked off already, kicks off and markets drop off 10, 20%, it's highly unlikely that's going to recover in 12 months' time for your house purchase. So it's not just a case of, protecting against inflation. It has to be built into what, your longer term financial objectives are for any money that you might be sitting on that you're concerned about the impact of inflation.
Okay, and just when you mentioned the uncertainty that's around, and we seem to have gone from one bout of uncertainty to another, but with what's happening in Ukraine, that's how sort of is now a good time to invest, or is now a good time to hold? I know one or two people who've sold their shares and they just said, I'm holding it in cash, even though they're obviously, from an inflationary perspective, they're losing money, but they think it's better to have it in cash than anything else.
They're sleeping at night, arguably, but honestly, that's the worst thing you could do. There is endless amount of data out there about why you should never time the markets, why you should never be trying to predict what the bottom is, what's going on. It's arguably one of the main questions we ever get asked, isn't it? What's going on? What's going on in markets? What can I expect returns next year? What can I expect as a return on my investment? Is now a good time to invest? And the honest answer is I don't know. We don't know. Anybody that tells you they know is completely lying. There's very few people that would have predicted what's playing out in Ukraine. I think most fund managers and most people have been caught out by how quickly it's escalated. Okay, and the knock-on effects of that. And you look, well, we're still arguably in a pandemic, but 2 years ago, when COVID hit, very few people would have predicted that the implications of that, or even the knock-on effect of that beyond that, that within 3-4 months of markets dropping 20-30%, they'd recovered and higher values than they were previously. So trying to time the markets, trying to predict what's going on, that's not what we do. That's not what you do as a financial planner. It's a case of having conversations with clients and saying, I mean, the example I gave before, somebody saving for a house, maybe, you know, I have X amount on deposit. I'd like to buy a house, or I'd like to retire, is one of the main objectives in 20, 30, 40 years, it may be, depending on their age. The impact of what's going on in markets now is going to have very little consequence in the longer term, unless obviously a nuclear war kicks off, and then at that point it doesn't really matter what's going on or where your money is, because we're all doomed. But in terms of the longer term planning, what's happening in the short term over a 2, 3, 4 year period should bear little relevance in a long term financial plan. And on that basis, when we are discussing investing with clients, you wouldn't be advising a client invest if they had a time horizon of 3 to 5 years. Really, you're looking at longer term, because it allows for market volatility and uncertainty and things like we're seeing right now, Ukraine, COVID. You know, it's very difficult to predict these things, or the knock-on effect.
So when you're talking about time horizons, then, so if you take an example, I think there's a reasonably large amount of people, certainly in Ireland, I know 1 or 2 of them might be even on the call, but because tech stocks have been so buoyant in, say, the last 3 to 5 years, they've made a considerable amount of money. They're overexposed in maybe one type of stock, which is their employer, where they've generated their wealth from. If they can't, they're nervous, they cash out, so they're holding a bunch of cash. Do they have to then reinvest that for another 5 years, or can they reinvest it for 2 years, or do they reinvest in 10 years? Like, I think people are like, what do I do now?
It's everybody's different, and a couple of things you're looking at there. I mean, firstly, if they were still invested in those company shares, the volatility that you'd be seeing there. I mean, even prior to what we've been seeing in Ukraine the last 2-3 weeks, those individuals that might have significant shares in their companies, tech firms particularly, will have seen the value of those drop prior to what we've been seeing the last 3-4 weeks, and that's because of the inflationary concerns that we touched on earlier, and the knock-on effect of that, of central banks, notably the Fed in the US, pricing in interest rate rises, which generally means an outflow and a reduction in value of growth stocks such as technology. So, excuse me. Apologies. So yes, from that perspective, it's diversification is key if they're in individual stocks like that. If they've already cashed out, is now a good time horizons? It's a case-by-case basis, because an investment, there are varying degrees of risk to an investment, and that's something you discuss with the client as well. It generally comes down to their age, their overall wealth, how much they're investing, and importantly, time horizon. Realistically, over a 2-year period, other than your typical savings accounts or anything like that, which as we're well aware, you're not getting very much return on at the minute, there's not much else I'd necessarily be saying you should be looking at. But there's no harm in speaking to an advisor and gathering their thoughts. Importantly, one of the main tools I use and we use at Abbey Wealth from a planning perspective is cash flow analysis and forecasting. So often when you're running through that with clients, they say, well, I'm going to need this money in 2 years' time, or I don't want to invest it because of certain things. Maybe want to do this, want to do that. Actually quantifying those things they want to do, or the various other bits of wealth, indicate that in actual fact, yes, you do want to do this in 2-3 years' time, but that's only going to use up 50% of your savings. So we can put half of it away for the longer term. The rest of it we can keep in cash to fund whatever your needs are. So it differs, and it doesn't have to be all or nothing. It's a case by case, and depending on what those individuals are looking for.
Okay, and longer term is, you're talking kind of north of 5 years, possibly 10 years sort of thing.
Yeah, 5 years plus. I mean, if you look back at the more recent global financial crash 2008 and the implications that had. That was a full-blown financial crisis. The credit market dropped out of the world economy. That had you been unfortunate and you invested the summer of 2008, markets were at their peak before everything has started dropping off. It would have taken you 5 years for the most part of sitting tight to regain your losses. And that is the main reason why you're looking at time horizon, and not trying to time the markets, but two, ensuring you've got sufficient time that if you are unfortunate in the timing because of what's going on, completely out of your hands, completely out of your financial advisors, your investment managers' hands, that you have time in your hands for that to recover, or it's funds that you're comfortable in knowing that you can tie up.
Okay, speaking of funds here, there's one about ETFs, and do you recommend ETFs, and is there particular ones depending on where you're living or where you're domiciled?
Yes, there would be. Generally in the European market, you'd have funds that are a large number of them are based in Ireland, Luxembourg, and the UK are the main three. So again, particularly speaking to Irish resident clients, potentially if they're non-domiciled as well, that's very important in terms of potentially not remitting funds to Ireland by investing in Irish domiciled funds. But there's there are thousands, and this is something else I guess you should say when speaking to an advisor is, what product availability they have, from an investment perspective. You look at your typical, I'm not going to name names, certain life companies here in Ireland, where you might have your pensions with them or even investments. You're generally restricted to 50 funds, maybe at most 50 to 100 funds, in what we term an open architecture investment, a platform or another investment vehicle. Potentially you can have access to thousands of underlying funds. So that could be ETFs, that could be actively managed, or passive as they're called. You should have a wide choice of where you want to put your money.
Just a couple of things. You're in a safe space now, Ewan, so you should name names. We like it when people name names.
No, well, talk to me after, and I'll give you the info. Well, there's only a handful of them here and in Ireland, and they're all very similar. I think it's worthwhile covering off. I said at the start of the call, one of the main things you should be speaking to asking a financial advisor is cost. How much is it going to cost me to speak to you, for you to give me advice? Ireland, Ireland's still a jurisdiction where its advisors are still able to get commission from a product. So they will invest your money somewhere, and they would get a commission payment from that particular provider. Firstly, they should be giving you details of that, and if they're not, you want to be querying that. Okay, well, I'm putting this money with them. What are you getting for this? Okay, but in the UK, for example, it's probably a perfect example of it. Back in 2013, they eliminated commissions entirely. They said, look, we're not having this. It's purely fee-based. So if you're giving advice to a client, you're charging them an upfront fee and ongoing fee. But in Ireland, you have the two options, commission or fee-based. But you'll find that in Ireland, a lot of these life companies, the main companies, are generally quite expensive, and they still pay quite high commissions to advisors. And it might seem like that's not necessarily a direct cost or a cost to you when it comes to commission, but in essence, it would be, because the management charges you're paying these companies is paying for that commission that you're receiving. Okay, that's how certain companies recoup their costs. Okay,
and not your words, but advisors could be advising products that give them the best commission as opposed to the best return. Not your words,
but potentially. That's
how do you guys charge?
Well, it depends on the product of both, but in the instance that, let's say, that the best product to be proposing to a client were to be a commission paying one, we're fully transparent about that. It would be a case of, look, this is how much it's costing you, this is what we're getting back from this particular provider. Typically in Ireland, with a number of these providers, you have an allocation rate. You invest 100,000, you'll have an 100% allocation rate. You theoretically have the ability of most of them to get 105% allocation rate, but that additional 5% is normally what advisors take. Some of them will reduce it to make it a bit more competitive. Some of them will take it all. Generally, from a cost perspective, Abbey Wealth, we it all depends on what the work involved is. You know, pensions are generally a lot more complex, need a lot more work involved in them, but we'd be charging, it tapers down depending on the investment amount, but at 1% per annum. But you're getting, and that's for an ongoing relationship and ongoing advice on the investments, but you're getting access to lower cost platforms and vehicles is the intention. You know, you're saving money elsewhere.
I have a question here on pensions, but before that, just when you talked about the thousands of different products, there's one that came in on just cryptocurrencies. Are they good investments, or are there fund type setups for cryptocurrencies as well? Any experience in that area?
It's still a very cryptocurrency is still very unregulated area of investment. I mean, personally, no, I don't invest in cryptocurrency. Too high risk, too volatile for me. Yeah, but I don't know. I think the technology behind it, blockchain, is a positive and has I think a long way to go. But purely from a cryptocurrency perspective, at the minute, I wouldn't be a fan. I just don't think there's any intrinsic value to it really. But at the same time, this ties in. If I was speaking to a client and they say, you know, I've got this money, but I like crypto. I want, you know, I know it, I understand it. I like to take a bit of a punt on it. Absolutely fine. You know, I guess my job as a wealth advisor would be to manage that risk and say, well, okay, that we're looking at 100,000 as the figures we were using earlier. You've got 100,000 there. How about with 5-10% of that, 5-10,000 euros, you go away, you take a bit of a punt on cryptocurrencies there and see how it goes. The remainder we'll invest in a range of diversified funds that are in line with whatever your risk profile and investment horizon is, because similar, I guess that ties in, cryptocurrencies ties in similar to individuals that might be holding, you know, stock options, company shares, etc. in one particular company. The lack of diversification there and the volatility of those investments and assets is the bigger concern. You know, when we're proposing an investment to a client, there are multi-asset funds that we use, one individual fund that within it has in excess of 14,000 holdings in one particular fund. That's an index tracking fund, so it comes in at very low cost, but the exposure you're getting in that the risk of a particular company, industry, or country really being quite volatile. I mean, you look at what's happening in Russia, Ukraine, Russia at the minute. The Russian stock exchange has plummeted, as you'd expect. Various sectors, you know, the oil sector at the minute is doing relatively well because of the restrictions there, but it fluctuates. So if you have a very diverse portfolio and a whole range of different investments, the theory being one particular company, for example, defaults, you know, bankrupt, it should have a very minimal impact on your greater portfolio.
Okay, one question here is just on pensions. There's two on pensions, but first one, what's the earliest you can cash out on a company pension in terms of age?
It depends on the scheme rules, but they vary from company to company. But typically, you know, 55 is when you could look at that. It would differ.
So 55, yeah, but it depends on the pension. Okay, and then following up on that, because I'm conscious we've probably only got about 5 or 6 minutes left. If anybody has questions, we're going to wrap it reasonably soon. So get your question in the Q&A. Just another one on pensions was, if someone has a company pension, should they contribute more on a monthly basis, or should they invest the money somewhere else? I guess that someone has a monthly pension and they want to increase their pension contributions. So if they're maybe putting an extra 500 or 1,000 a month, should they put it into the pension, or is there a vehicle that you guys can provide that they put that money into? What does that look like?
Well, there would be alternative pension schemes outside of the company pension, which arguably would be more favourable from a cost and investment perspective. Yes, but if you look at it purely from a, so yeah, it's worthwhile speaking to an advisor, but if you look at it purely from a pension, just a pension perspective, should I put more money into a pension, or should I invest it somewhere else or do something else with it? In simplistic terms, yes, it's free money. You get tax allowances on that, particularly if it's a company pension. Your company might match your contributions. Okay, so again, free money. If you're a higher rate taxpayer, if you're a higher rate taxpayer paying 40%, and you, let's say, contribute 200 euros to your pension, that at a cost to you is only 120 euros because of the tax allowances and tax breaks you get on that. So clearly it's well worthwhile doing. But at the same time, this is the importance of looking at the bigger picture and financial planning, because it might very well be that, you know, you don't have the ability to put that extra money in because you need it for something else, you know, elsewhere. You know, you're saving for a deposit for a house, for example, or something along the lines of that. Though, yes, the tax advantage on the pension would be great, and we're looking longer term retirement planning, but your main concern at the minute is, you know, getting out of your parents' house and buying your own place. So case by case, but simplistically, yes. And I mean, it's worthwhile remembering as well, you know, that the government give you those incentives, and it's not just in Ireland, this is in most countries, because they want you to be less of a burden in retirement on them. I mean, in Ireland, the state pension is 13,000 euros a year currently. So I think there's very few people that would survive or be able to manage or live off that alone. So that, you know, that's the importance of why you should be looking at it. One of the main financial planning needs is retirement planning and looking at your pensions.
Okay, and I think possibly you can, if you had two pensions, you could have one with your company that could be a more conservative pension, and then you could have a private pension on the side, which could be more high risk pensions. That
yeah,
quite often what people do.
Well, personally, yes and no. Well, you could do that, but again, you want to be looking at things holistically. So if you're in your 40s, let's say, you're looking at retiring at, you know, normal retirement age, mid-60s, 65, let's say, you know, you've got 25 years time horizon for investing there. You're probably going to see another, you know, 2 financial crashes during that period, potentially. You know, God knows how many wars. But the short-term volatility is going to have little relevance because you'd expect markets to grow over the longer term. But when looking at the strategy you apply in those, to me, I'd be looking at everything and saying, well, okay, if this is if you've got a 25-year investment horizon, you have a company pension there that's in a low risk strategy, then we can afford to take higher risk in this one to compensate. Or in an ideal world, it might be that, you know, why do that when you can have a similar strategy in both that's in line with your longer term risk profile and investment needs. So, but it might be, for example, your company pension. You have very little fund choice. There's not much you can do with that. You've only got these low risk funds as an option, and consequently, to maximize your return elsewhere, you've got to look at higher risk funds elsewhere.
Okay, and that's the kind of service that a company like Abbey Wealth, it's that flexibility is, and that expertise is what you guys are offering.
Yes, I mean to cover off, we have obviously we're a company that's based in Ireland, but we have offices in Spain. We have an office in Switzerland. We're licensed through the central bank in Ireland. We have an investment insurance license here, and we have well, at last count, we've got clients in over 136 countries globally. With about 4,000 clients and about 850 million euros under service, under advice. So we help individuals everywhere, but it's a case of, yeah, when I speak to a client in the first instance, it's getting a picture of their overall financial situation, using tools, like I said, cash flow analysis and forecasting to see, you know, under their current circumstances, where they might be in 5, 10, 15, 20 years, and tailoring possibly the structure and things they have in place now to improve on that, whether it be, you know, moving a pension to a lower cost pension, or a pension that gives you a greater investment choice, with the theory being to improve the returns.
Okay, very good. Well, there's no more questions, so I think we're at about 30 minutes there. So I think we'll leave it at that. As said, we'll post the video and recording on our social, and we'll email it to everybody that signed up. So To round it off, thanks a million for your time. Great advice, Ewan. Very helpful, very insightful.
Thank you, Philip.
And thanks for everybody for turning up. Yeah. Thanks, you all. Nice to see you.